total revenue hit $1.312 billion.
Yeah.
That's a 2% increase year over year. Adjusted EPS came in completely flat at 23 cents, and GAAP EPS hit 19 cents. But look, the real story for ADT's Q2 2026 earnings is the cash.
Right. The free cash flow it's just massive this quarter.
Yeah, adjusted free cash flow, including their interest rate swaps, it basically exploded to $406 million.
Okay.
I mean, that is a 48% increase year over year. And based on that, management actually raised their full year 2026 guidance.
Which is pretty aggressive, honestly.
It is. They're projecting adjusted free cash flow growth of roughly 30% now, up from that previous 20% target, alongside about 2% growth for both total revenue and adjusted EPS.
And that cash story is exactly the mission for this deep dive today. We are breaking down how a 150-year-old legacy security company is basically squeezing out this massive free cash flow. For you as a retail investor, you really need to look under the hood at their segment shifts.
Right. The move away from subsidized hardware.
Exactly. The shift away from subsidies and the execution risks of this brand new AI-driven strategy they're rolling out. Because, look, a 48% jump in free cash flow doesn't just happen by accident. They are fundamentally rewiring the traditional business model.
So let's start with that rewiring, because 48% is a huge jump. Right. And when I look at the actual GAAP operating cash flow, it came in at $666 million, up 18%. I mean, how are they actually generating that? Revenue only grew 2%. So they aren't just selling 18% more alarms.
No, definitely not. The revenue growth is super modest. That cash engine it's almost entirely driven by financial discipline on the cost side. It's really three main levers.
Okay, what are the first two?
Well, the first two are pretty straightforward: corporate finance, tighter management of working capital, and significantly lower cash taxes.
So working capital meaning like the flow of cash in and out.
Exactly. Collecting cash from your customers faster while, negotiating longer terms to pay your own suppliers.
Right, basically holding on to every dollar just a little bit longer before it physically leaves the building.
Right. It's a classic efficiency play. But the third lever is structural. It's a really notable drop in their subscriber acquisition costs, or SAC as the industry calls it. Their net cash SC actually fell 7% year over year, down to $345 million.
Wait, let's pause on SAC for a second, because subscriber acquisition costs has been, it's the historic Achilles heel of the entire home security space.
Oh, 100%. It's a cash furnace.
Right. For decades, the model was like you pay a tech for 4 hours of labor,
Yeah.
you bolt $1,000 worth of cameras to a house, and you charge the customer, what, $99 up front?
Pretty much, yeah.
And the company just eats that massive upfront loss and prays the customer stays on a $60 monthly contract long enough to break even, like 3 years later.
That is exactly the dynamic. You spend a fortune upfront and you wait years to recoup it. So by shifting that dynamic, by making the consumer shoulder more of the upfront equipment cost, they're retaining way more of their operating cash right out of the gate.
So it drops straight to the bottom line.
It does, but, it completely changes the customer relationship.
Yeah, and here's where I start to look at this a bit critically, because when a mature legacy company suddenly generates this much cash, the very next question is capital allocation. Like, where's all this money going?
Oh, they're returning a lot of it.
A ton of it.
Yeah.
They returned $684 million to shareholders in just the first half of the year alone. That includes buying out Apollo's 29 million share stake. And they still have $906 million left on a $1.5 billion share repurchase authorization.
It's a massive buyback program.
It is. So if adjusted EPS was dead flat at 23 cents, I have to ask, is this aggressive buyback strategy just like a way to mask stagnant earnings? Just financial engineering milking a cash cow?
Well, it's a fair pushback. But if you zoom out and look at the whole balance sheet, this posture is actually highly defensive. It's very shareholder friendly. It's not just blind financial engineering to, artificially prop up the EPS, because you have to weigh the stock buybacks against their debt strategy. They are aggressively targeting a net leverage reduction down to below 2.5 times.
And where are they sitting right now?
Right now, they're at 2.8 times. So they are actively using that cash flow to pay down debt simultaneously. They're de-risking the balance sheet.
Okay, so shrinking debt and shrinking the share count at the same time.
Exactly. And look, buying out a huge private equity backer like Apollo, that removes a massive supply overhang from the open market.
Mm-hmm.
When a private equity firm holds that much of your stock, retail investors are always terrified they're going to dump it and crater the price.
Right. The PE firm eventually wants their exit liquidity.
Yeah. So removing that threat is a huge structural positive for the retail shareholders that are left. proving you can shrink the share count, pay a dividend, and reduce debt all at once. That's the hallmark of a really healthy cash engine.
Okay, fair enough. But distributing hundreds of millions in cash is a really risky game if the core operations are faltering, right? I mean, eventually, you run out of debt to pay down and shares to buy if people stop actually signing up for alarms.
Absolutely. The core business has to hold up.
So when we transition to the segment data,
hmm
how is the revenue mix actually supporting this? Because when I look at the two main business units, I see a pretty stark divergence.
Yeah, the divergence is basically the clearest indicator of their whole strategic pivot. So their core segment, monitoring and related services, or M&S, that actually dipped 1% to 1.082 billion.
Right, down 1%. But didn't management flag that?
They did. They pointed out this was largely expected because of a multifamily divestiture they did back in October of 2025.
Right.
They essentially carved out and sold a commercial-leaning piece of their residential business that did like large apartment complexes.
Got it. So that explains the slight dip there. But the other side of the house is where the numbers get really weird. The security installation, product, and other segment jumped 17% to 230 million.
It's a huge surge in product revenue.
It is, but then you look at the underlying subscriber metrics. End of period RMR, so recurring monthly revenue, is down 1% to 360 million, and their total ending subscribers dropped 5% down to 6.1 million.
Right.
So they are selling 17% more equipment, but losing 5% of their total subscriber base. Are they literally cannibalizing their highly valued recurring subscriptions just for one-off equipment sales?
I mean, it looks like a harsh trade-off on paper, but this is a very deliberate shift in transaction mix. Management is intentionally moving toward what they call outright pro-install equipment sales.
Wait, so instead of that old subsidized model where ADT just eats the cost of the hardware, they are making the customer pay full retail price for the cameras and the panel on day one.
Basically.
Doesn't that create massive friction? Like getting someone to sign a contract when they suddenly have to write a check for $1,000?
Oh, it definitely creates a higher upfront barrier for the consumer. But for ADT, it drastically boosts that upfront product revenue, which completely explains that 17% jump you saw.
Oh, okay. So it's an immediate cash injection.
Exactly. It immediately improves their margins and just completely stops the cash drain of subsidizing new accounts. That is exactly how they drove down their subscriber acquisition costs by 7%.
Because they aren't bleeding cash on day one to acquire the customer anymore.
Right. And the real validation here, the metric you have to look at, is the revenue payback period. Over the last 12 months, the time it takes them to earn back what they spent to acquire a new customer stayed perfectly stable at 2.3 years.
Okay, so they're still recovering their costs in under 2.5 years. But the actual cash dynamic on day one is way better.
Exactly. It's a much healthier cash cycle.
It totally explains the 48% free cash flow jump. But I still can't just brush off the fact that they lost 5% of their subscriber base. You know, you can't just ignore attrition.
No, you absolutely cannot. In a subscription business, that is the big warning light flashing on the dashboard. Gross revenue attrition ticked up 30 basis points year over year to 13.1%.
Which means 13.1% of their recurring revenue just walked out the door over the last year. It did.
And for a business with 6.1 million customers, a 30 basis point increase in attrition is a very real, very painful loss of monthly cash.
It is. But management was actually very specific on the earnings call about the mechanics of this. They noted the elevation is being driven almost entirely by non-pay cancellations.
Okay, non-pay cancellations, which honestly tells us a lot about the broader economy right now.
It's a huge macro indicator.
Yeah, because a non-pay cancellation usually doesn't mean a competitor offered a cheaper system or they moved and left the gear behind. It literally means the consumer just cannot afford the monthly bill anymore.
Right, their credit card is bouncing.
And home security is usually one of the last utility-like bills you stop paying. If non-pay cancellations are spiking, that shows some severe stress on the lower to middle income homeowner.
That is the exact takeaway. The consumer wallet is just completely stretched. But the interesting caveat management provided is that this spike in non-pays was actually partially offset by fewer voluntary disconnects.
Wait, really? Oh, so it's almost like a gym membership during a recession? How do you mean?
Like the people who actively use the gym, who can actually afford it, they stay. But the people who are just kind of holding on to the membership as a nice to have, they're finally cutting the cord because budgets are too tight.
That is a perfect analogy. The customers who have the disposable income to keep the service are sticking around at even higher rates than before, so the core product remains incredibly sticky. The brand loyalty is still there.
But the macro environment is just forcing the lower end of their market to capitulate,
Exactly.
which kind of forces ADT into a corner, right?
Yeah.
If the core pro-install subscriber base is shrinking by 5% because the lower end is tapped out, they have to find a new way to reach value-conscious consumers. You can't just keep trying to sell premium, multi-thousand-dollar custom installations.
Right, you need a different funnel. And to combat that creeping attrition, management is heavily hyping their new product pipelines.
Yeah.
They are placing two very distinct large bets on future tech.
Okay, so let's shift to those growth levers. What's the first one?
The first is the rollout of ADT Blue, BLU. This is a self-installed DIY security system that comes with optional professional monitoring. And they are pushing this super heavily into e-tail channels, specifically highlighting their availability on Amazon.
Wow, okay. That is a total paradigm shift for a legacy brand like ADT. I mean, instead of a technician in a branded van spending 6 hours drilling holes in your drywall, you just order a box on Amazon, stick the door sensors on with some 3M tape yourself, and decide later if you actually want to pay the monthly fee.
Exactly. It dramatically lowers the barrier to entry for the consumer.
And critically, it lowers the acquisition cost for the company to basically zero.
Yes. By completely removing the labor cost of professional tech and shifting the hardware cost entirely to the consumer via retail pricing, ADT can finally compete directly with the DIY disruptors.
Right. The simple safes and rings of the world that have been eating the bottom end of the market for a decade.
Exactly. But the second tech initiative they discussed is arguably much more revolutionary, and that's the acquisition and integration of Origin AI for what they are calling presence sensing.
Yeah, I have to admit, when I read through the source materials on Origin AI, I literally had to stop and read it twice.
It's wild technology.
It is. It's essentially turning a home's existing Wi-Fi network into an invisible tripwire. There are no cameras, no motion sensors screwed into the ceiling, no Apple Watches or wearables. The software literally detects the physical disruption of Wi-Fi waves bouncing around the room when a human mass moves through them.
Right.
It's like sonar, but it's just using the Wi-Fi router you already have plugged into the wall.
It is genuinely cutting-edge ambient tech. The home itself basically becomes the sensor.
But the question for you, as the financial analyst here, is how does sci-fi tech translate into actual earnings?
Yeah.
Because we see legacy companies buy flashy AI startups all the time, and it rarely moves the needle on EPS.
Oh, totally. But the financial logic here is brilliant because it unlocks a massive, highly lucrative demographic that traditional security completely fails to capture. The aging in place market.
Oh, interesting.
Yeah, think about the mechanics of that demographic. You have adult children who want to monitor their elderly parents, right? Just to ensure they are up and moving around normally or that they haven't suffered a fall in the kitchen.
Right.
But elderly parents rightfully hate the idea of having traditional security cameras installed in their living rooms or hallways or bathrooms. I mean, it is deeply invasive. It strips away their dignity.
Yeah, the privacy aspect of that is a total non-starter.
Yeah.
I mean, I wouldn't want a camera in my hallway either.
Exactly. Nobody does. So Origin AI solves that friction entirely. It provides movement data of verifying someone is, walking around the house normally without any optical surveillance.
So no video feeds for a hacker to intercept either.
Exactly. And from a financial perspective, this has the potential to create a brand new, highly sticky stream of recurring monthly revenue. And because it operates through their existing ADT Plus software platform, it essentially functions as a pure margin software upgrade.
Because it doesn't require rolling a truck to install a physical medical alert system.
Exactly. If they can successfully bundle this Wi-Fi sensing into their existing subscription tiers, the incremental revenue goes straight to the bottom line.
Okay, I see it. A Wi-Fi tripwire that prints high-margin recurring revenues sounds like every tech investor's absolute dream. But look, tech innovation on an earning position is very different from execution in the real world.
Oh, execution is everything.
Right. So when we talk about AI, we really have to look at how they're embedding it into their actual operations today, not just tomorrow, because it's never as simple as flipping a switch.
No, it never is. And management actually detailed several internal AI initiatives that are currently live. And honestly, they're driving a lot of that cash flow generation we opened the show with.
What kind of initiatives?
They are heavily utilizing AI for inbound call containment, virtual agents, and intelligent call routing.
Okay, so by call containment, you mean using an AI bot to solve a customer's problem so ADT doesn't have to pay a human operator to take the call.
Yes, exactly.
But how impactful is that really? I mean, doesn't literally every company have a chatbot now?
They do, but in home security, the impact is uniquely huge. Think about the nature of customer service calls in this specific industry. A vast majority of them are not actual break-ins or
The
emergencies.
false alarms.
False alarms, forgotten passcodes, or, a door sensor battery dying and beeping at 2 a.m. Historically, human operators had to field every single one of those routine calls.
And paying thousands of call center operators to tell people how to change a AA battery or reset their passcode is just a massive drain on cash.
Precisely. By automating those specific, highly repetitive interactions with AI, the human operators are left only for genuine emergencies or really complex troubleshooting.
So it drastically cuts the headcount they need.
Exactly. By lowering the aggregate cost to serve those 6.1 million active subscriptions, they are structurally improving the profitability of every single dollar that comes in the door.
Okay, let me play devil's advocate here, though.
Right.
Because when you actually dig into the 10Q risk disclosures, the fine print in the financial report, it is incredibly heavy on tech execution risks.
For sure. It's a major pivot.
Right. Between attempting to integrate a complex software acquisition like Origin AI, rolling out a brand new DIY platform with Blue on Amazon, and relying heavily on their strategic partnership with Google for their core smart home ecosystem. I mean, aren't they exposing a legacy hardware company to massive software execution risk?
It is an excellent point, and it's a material risk every retail investor needs to price in. They are taking a 150-year-old physical response company and trying to pivot into a software-defined tech ecosystem. And the notable risks outlined in the report are stark.
What's the biggest one?
First, the shift in the transaction mix toward outright sales changes the timing of their revenue and costs. Under the old model, revenue was highly predictable over a 3-year contract. Under the new model, earnings might look incredibly volatile from quarter to quarter based entirely on how much equipment they sold up front.
And Wall Street traditionally hates unpredictability
They despise it.
because it makes modeling a nightmare. One quarter looks like a massive miss on revenue, but a beat on margins. And then the very next quarter totally reverses, just depending on hardware sales.
Exactly. The predictability of the old subscription model is essentially being sacrificed for the sheer cash generation of the new model.
Ah.
Furthermore, their reliance on third-party providers is a huge structural vulnerability.
They're comma Google.
Yeah, their partnership with Google is central to their ADT Plus platform. But Google is a behemoth that frequently pivots, abandons, or changes its smart home strategies.
Google Nest.
Exactly. Relying on them means ADT doesn't entirely own its own destiny.
Not to mention the cybersecurity aspect of all this. I mean, if you are turning the home's Wi-Fi network into an ambient sensing net, the threat of cyber attacks on those interconnected systems becomes existential.
Oh, the liability is off the charts.
Right. It is one thing if a hacker disables a traditional door alarm. It is an entirely different level of liability if a bad actor gains access to a whole home intelligence platform that physically maps out the movement of the family inside the house.
It's terrifying. And that leads directly to the final major risk management highlighted: evolving AI regulations. The regulatory landscape around data privacy, ambient sensing, and AI-driven customer handling is completely fluid right now.
Yeah, nobody knows where the laws are going to settle.
Right. Any sudden shifts in telemarketing laws, privacy requirements, or AI legislation could force them to rebuild these highly efficient systems completely from scratch. Which brings us back full circle to why maintaining that defensive balance sheet and bringing leverage down below 2.5 times is so critical. They are building a financial moat to give themselves room to execute on this incredibly complex operational pivot.
So what does this all mean for you as an investor? I mean, you have to wonder if ADT's transition from a heavily subsidized subscription model to outright DIY sales and AI customer service will successfully attract a new generation of homeowners.
Yeah.
Or, and this is the real risk, if it will simply commoditize their premium white glove brand identity in what is already a very crowded smart home market.
It's the ultimate question for their long-term valuation.
Absolutely. If you want to stay ahead of the curve and catch these trends as they happen, make sure to follow the show for our daily earnings coverage.